Hey guys, today I'm going to talk about buying versus renting. So to properly compare buying versus renting, you really have to look at the cash flows that are associated to both. Now, the reason why I'm positioning it that way is the reality is when you buy a property, you usually spend more money at the beginning, in the middle, and at the end than if you were to rent a property. Now, what I had done was on a financial basis only. I did not look at the qualitative reasons for buying a property versus renting a property. Trying to figure out, over time, am I going to be better off buying a property rather than renting? And now, I split it into three segments of buying a property when it comes to cost. The first segment is when you buy the property. So the first thing you need to do is you've got to have a down payment. If I have a $500,000 property and I have a 5% down payment, that's $25,000. So for me to compare buying to renting, what I did was I assumed the buyer had to spend $25,000 today and the renter also spent $25,000, but instead of using it to buy a property, they bought investments that would grow over time, not unlike the stock market or bonds or mutual funds or something like that. So that's the assumption that I had made. And that's one example of all the different things that a buyer has to spend money on that I basically assumed if I'm going to spend it over here, I'm also going to spend it over here as a renter. So level setting that, you have an understanding of how I compared apples to apples. Now, when you buy a property, you have the setup costs that are associated to it. That's the first tenet. Second is the maintenance costs, and finally are the selling costs. So when you buy a property, here are some of the costs that you have to be mindful of. The first one is an inspection. It's usually about $750. Next, you also have notary documents. It's probably about $1,000. Next, you also have what's called a Canadian Mortgage Housing Corporation insurance premium. This is a requirement that people who buy a property have to purchase insurance that covers the bank should you default on your mortgage. And the reason why we have this in Canada simply is if a lot of people are defaulting on their mortgages, our banks are going to be in a lot of trouble. So there's this agency that covers the banks to make sure that everything is okay in our economy. I don't need to get into the details, but that's basically what it is. So when you purchase a property with a down payment of less than 20%, so in the example of a $500,000 house, so $500,000 times 20%, that's $100,000. If, when you're buying a property, you don't use $100,000 of your own money, in this example, you use less than that, you are now legally required to spend money on this Canadian Mortgage Housing Corporation insurance, CMHC for short. Now, in the instance of a 5% down payment with a $500,000 house, you have a $25,000 down payment, your CMHC premium would be 4% on top of that. Now, you don't need to spend that money out of pocket today. Typically what happens is you take that 4% and you tack it onto your mortgage, so you're going to pay it back over time. But the reality is that is an expense. It does not add any value to the equity in your property, just like a notary fee or an inspection fee. These are monies that you spend that you do not get back. And I'm highlighting that because there are a lot of those sorts of fees that happen when you buy a property that are very comparable to rent. Because when you rent a property, as we all know, you don't get that money back. The last thing that I wanted to mention when you buy a property is called a land transfer tax or a welcome tax. And that ranges from anywhere from 0.5% or 1.5% of the value of the property of when you purchase it. Now you also have the maintenance. Of course, when you buy a property, you have to maintain the property, you have to change the roof, you have to look after the lawn, you have to remove the snow. These are all different costs. As well, you also have the taxes that you have to pay on a regular basis. Now in Montreal, for a $500,000 house, give or take, you're probably looking around $7,500 a year in taxes. Again, this is money you don't see again. So the renter paying his rent, the house guy, he's also paying for those taxes, which are not unlike rent. And finally, of course, you've got your mortgage payments, which are every month, and a portion of that payment goes towards the interest on the mortgage to borrow the money to buy the property. And again, you don't see that money back again. It's an expense to owning your property. Now, the last thing is when you sell the property, you'll have some other legal fees like notary fees, certificate of location, those are small fees, and you also likely have a realtor fee, anywhere from 3 to 6% of the value of the sale. Again, that's money you spend and you never get it back. All of these costs don't increase the value of your property. All they do is maintain the value of your property. Now, the example I did, of course, is I compared all those costs with a renter. He's investing that money every month or at the beginning or at the very end, and he's earning whatever interest he would be earning on that money to make a proper comparison between buying and renting. So this is what I did. Now, crunching the numbers, the conclusion I came up to surprised me because I thought it just made sense to buy a property every single time, but it is not the case. I found that if you don't own the property for long enough, you're probably better off renting. So let me qualify that for you. If I owned a property for only 5 years, and then I sold it, and then I bought another property, and then I sold that, and et cetera, that 5-year window often was not long enough for me to benefit from the value increase of the property when comparing to renting something for 5 years. So if you're the type of person who wants to buy a property and then flip it every 5 years, you may not be in the best scenario. You may be better off renting a place and just moving every 5 years. You might actually have more net worth at the end of the day. The main factors that I found that influenced it was time, which is what I just outlined, the value accretion of the home, and I found if the value of your property didn't increase by more than, say, 3% a year, there was a lot of circumstances where renting actually made more sense. Because that 3% is really the gravy. That's the only thing that you're getting when you buy a property that helps offset all of those costs. Also, the interest rates today are very low, which is a great environment, which is allowing for buying a property to be a bit easier. But when interest rates start to go up when you borrow money, this is now making it less interesting to purchase a property than it is to renting a property. And then finally, of course, was the comparison of what am I getting when I invest my money? If the stock market being the kind of the proxy that I use to say I'm going to invest in the stock market, if that number was too low and maybe I was only earning 2 or 3%, more often than not, it made sense to earn or to purchase a property. But if I'm earning, say, 6, 7, 8, 9%, a lot of times it made sense that renting made more sense than buying because I'm earning a lot more on my money than I would be on purchasing a property. Now I've created, if you're an Excel geek like me, I've created an Excel sheet that kind of maths these scenarios out, and you kind of play with the numbers and put your down payment, and it automatically calculates a lot of the numbers that I've just highlighted in this video. So I invite you to click below and see if you have any comments or whatnot. Definitely check it out. Do all the likes, the shares, all that great social media stuff. I really appreciate your time today. Hope you have a great day.